couple of things going on right now. I have a bunch of clients. So the word that I use as I pull this up, the word that I use is onboarding, right? So Sheila, we do insurance for husband and wife, and then they have a rollover, and then they need college savings, and then they're starting a monthly investment. This is a little bit of a process, and it's a word that I've heard software companies use, where if you purchase a big software package, and they have to onboard the company. They have to integrate that software into the company system. And so we do the same thing. We have to onboard the clients, right? They have to become a Primerica client. We have to move all of their investable assets and all their products and services under us. And one of the things that I do with onboarding my clients is I do an investment, not presentation, an investment tutorial with them. I'm very thorough when I'm onboarding investment clients. Insurance doesn't take much onboarding. You actually don't really ever have to talk to them again. Insurance doesn't have built-in follow-up the way that investment clients do. So if you really want to build a book of business that keeps making you money, you want to get your investment license, and it doesn't mean that you have to be a straight-up financial advisor or get humongous trades, but you should be doing an investment with every single client. Whether you're licensed or not, you want to make sure of that, because when that person invests $200 a month in 3 years, when it's 10 grand, you're going to be calling them, you're going to be talking to them, and then one day when that $200 a month client, which we make nothing on, has 100 grand, they're going to call the person who is following up with them consistently. Does that make sense?
Yes.
But the biggest reason, do you have this?
ICA or the PowerPoint?
Bring up the PowerPoint really quick. The biggest reason I do this is because I want to have, I'm in a business that can create a lot of anxiety. And I already have anxiety. I don't want my clients to have anxiety, then I have anxiety. I want to have a good life. I want to have freedom. I want to make passive income. I do not want to be taking client calls all the time because I did a poor job on the front end, and now clients are coming to me wondering what's going on. So the way that I look at my job is to manage client behavior and expectations. And I didn't understand this in the beginning. What I would do is I would sell on returns. I would say, yeah, the market always does this, and these are the returns that we're going to get you. And that gets you in a lot of trouble. I actually don't talk that much about returns anymore. I talk about strategy, I talk about long term, right? I do project into the future, but short-term returns, you don't want to get into that game. My returns are better than yours. You don't want to do that. So I'm going to go through a couple of these things. Look at what we have here, right? What do I want to avoid? I want to avoid the client complaining about fees. We have to anticipate this. If you don't do a good job, my clients do not complain about fees because I've done a thorough job on the front end, not just disclosing the fees, which is duh, right? It's actually showing them that we are cheaper. Yes, with my investments, you have to pay upfront per deposit, but guess what? That's cheaper. So you have to present your case where it makes you look cheaper because we are. Now look, can someone get a cheaper investment if they go online, they open up their own brokerage account, they create their own allocation? Yeah, just like you could go paint your own house too. Just like you go wash your own car. Not everyone is equipped to do that or wants to do that. So the comparison is not, hey, these are my investments versus if you do it yourself. I don't believe you should be doing it for yourself. And we're going to be talking about that. Next, complaints regarding downturns. The market actually doesn't go down that often. Now, that word down is relative. The 20% and all that doesn't happen. In a calendar year, the market, if you look at calendar years, the market only goes down 1 out of 7 years. That's not bad. But the market is going to have many times throughout the year, typically, where it'll go down 5%, sometimes 10%, right? And you have these intra-year drops. And that's when the clients have anxiety. That's when they think about taking their money and moving it to the sidelines. That means taking money out of the market and into cash. Of the top 25 mutual funds last year, in 2023, 20 out of the top 25 in terms of collecting money were money market accounts.
Wow.
There's $7 trillion right now, with a T,
Wow.
in money market accounts.
Wow.
So although the market is rallying, unbelievable returns that the market is getting, a lot of people have their money on the sidelines. A lot of people have their money in cash and money markets, and yes, they're getting 4 or 5%, but the market is doing 20 and 30%. So it's always opportunity cost. If you're going to run to cash, right? If you're going to run to 5%, you're giving up 30%. And that's how the market works. So our job really is just to keep the clients invested, keep them in. That is our job. The market is going to do what the market is going to do. I don't control the market, but what I can do is I can help manage your behavior, set some expectations, educate you so you know what's going on, because guess what? If I can save you one time in 10 years of taking your money out and then putting it back in at the wrong time, if I can save you that just one time over our relationship, I could have saved you hundreds of thousands of dollars, and that in itself justifies whatever it is that you think you're paying me. Does that make sense? If we can prevent that one mistake. So, what do we have here? I want to show you guys this. This is what I use. It is me against you getting a similar type of service where you can call someone's cell phone. And nowadays, a lot of advisors, you cannot call their cell phone. I had a client I was talking to. He didn't invest with me, but we were just having a conversation. He has $4 million with Ameriprise. And he's like, see how we're having this conversation? I wish I could do this with my advisor. And I said, how does it work with your advisor? Well, you have to email them into like this company system, and then they email you back with a time, and then you have to choose, and by the time I get to talk to them, it's 4 days later. This is someone with $4 million. And Sheila and I, we can talk to our clients at midnight if we want to, or if they want to. So, let's look at a comparison. When you put your money with a financial advisor, typically what happens is you don't pay anything up front. What they do is they collect the fees over time on your lump sum of money. So, is it safe to assume that when someone invests, right, your money should theoretically be going up over time?
Mm-hmm.
So what they do is they charge fees the entire time, okay, on a growing balance. So if they're charging you 1%, guess what? 1% is only this much here, but 1% is a lot higher as the money is growing. If you have $1 million, 1% is $10,000 a year just in fees. A lot of people are paying 1.5 and 2%.
Oh my God.
You hear these radio commercials or whatever you listen to, you hear Fisher Investments, that's 2%. They say, if you have 500,000, give us a call. They charge 2%. Edelman Engine, Edelman Financial, 2%. And then the regular brokerages charge about 1%. It's very difficult to find under 1%. So this is what I do. I say, okay, let's say that, let's go down here. What are the assumptions? You have $250,000. There's our fund, and then there's a different, you go with a different advisor. So you have $250,000, all equal. We hold them both for 20 years, them versus us. Both of them perform at a 12%. I'm not saying that we're going to do any better than them. But their fund annually is a little more expensive. If you look at American funds, they're a great fund family because it's managed funds. It's not index funds. It's managed funds, but it's a very low expense ratio. It's about 0.5%. Other funds are charging 1%. But here's the big difference. Okay? Here's the big difference. Is that they're charging 1% annually, and we are charging nothing annually. That's the Primerica way. So let's see how this shakes out. you have to pay us a fee up front. When you put in $250,000, you are going to pay a 2.5% upfront fee. It's not that you write me a check, it just gets absorbed out of your investment. So your investment starts with about $6,000 less, okay? I understand if you go to a different financial advisor, you will not have to pay this, but let me tell you why it's better for you to pay it. Because look at this. The actual expenses in the fund, all right, that's similar. Over 20 years, 50,000 difference. I mean, it's a lot, but it's not humongous, right? But look at this. Not only are they more expensive in the fund, you have to pay the advisor as well, another 1%. Now, at the end of the day, after 20 years, in our fund, with the upfront investment and over time, you paid $114. With the other fund, you paid $300,000 in fees. Now you have a couple million in the account, right? So either way, you're going to be okay. But would you rather pay $100,000 in fees or $300,000? We are way cheaper when you do it our way. So this is available on the Capital Group website. It's called the Shared Cost Calculator. You have to learn how to use it. Obviously, you have to have a securities license. But I've been using this since day one to overcome our system, our fee structure versus other companies. So let's move on. One of the things that I help people understand that are new. So the lady I'm working with now, her husband died. She has $1.4 million to invest. She's never invested before. So this is what I know. There's another young guy that I'm working with. He has about $300,000. He's 26. He owns a big construction company. He's never invested. When people think investing that have never invested, I sat down with that guy the other day, the kid, and I said, "You've heard of Robinhood, right?" He goes, "Yeah." He hasn't heard of anything else, but he's heard of Robinhood. Okay? 99% of the time, if you are using Robinhood, it's because you are playing the stock market and you're gambling. I'm not saying there's anything wrong with it, just like you can bet on the game. You can bet on the game, you can bet on a stock. Most people don't really know what they're doing. They're just putting money in and they're hoping that they get an outsized return. But it's also the same way that all the horror stories that people tell in terms of losing money. So let's look at this. During the pandemic, Moderna made a lot of money. You could have 2,300%, and then it went way, way down. And people say, "Yeah, well, it's still up 600%. I know, but you didn't invest here. You invested here, and you're down. Okay? We have Zoom. Zoom went up to $500-600 a share. It's literally below its pre-pandemic price. Wow. This is called the round tripping. Okay, so it went up and then it round tripped all the way back down. You see Etsy. Etsy has completely tanked as a stock. Let's go down. Peloton, worst example in history.
Wow.
This isn't even updated. This is down 99.5%. Okay? I know a guy, he's my client now. He was referred to me because his coworkers were like, "You have to save this guy. He will not give up on this stock." He had over $100,000 in Peloton. It's basically worthless. And what people try to do is now they're chasing. What they're doing is that it's going down, so they start thinking, "Man, it was here, it's here. Let me put more money in here so that way when it comes back up, I can make up for my losses." And they do that here and here and here until that company is going to be acquired for nothing.
That's crazy.
DocuSign, very popular company when the pandemic, everyone adopted these types of technologies, and they're down big right now. Wayfair, that was another, big. So these are all, Robinhood is like a social media mixed with style. Like they tell you biggest movers, and this is what people are watching, and all, like large amounts of people are piling into these stocks. They don't have great fundamentals. I'm not hating on it. Sometimes you can ride that momentum, you can make money. I think smart money knows how to do that. Dumb money doesn't really know how to do that. But there are ways, okay? Another thing that I like to show my clients is that there's always a reason to sell. Right now, the market is at an all-time high, and if you listen to financial media, everyone is talking about how the market's too expensive, it's too high, it should go down, right? But the funny thing is they were saying that at the beginning of the year too, and now we're 20% later, right? So there's always a reason to get out of the market. Let's look at some recent stuff. When there was the bank failure, people said, oh man, this is another 2008. Look at the returns since then. Because people were thinking, man, is the whole financial system coming down? When Silicon Valley Bank went down, that was a very prestigious bank. But the market has gone up since. You have the war, market has gone up. It's unfortunate, right? But the market does not have emotions. It doesn't care. So it's hard to predict. The US, our credit rating as a country was downgraded. Interest rates, Russia, commodity spike, right? They were saying that there's going to be severe famine, power issues, energy issues in Russia, not in Russia, in Europe because of Russia. You know, at some point in the pandemic, the entire economy came down. The U.S. Capitol was swarmed. Inflation hits 40-year high. There's always some reason. This is a big one. This is the yield curve inversion. So, you know, finance nerds, what this means is that it's an indicator that shows that a recession is imminent, basically. Well, this has been flashing for a couple years now, and the recession never came. So if you're that smart guy who's like, oh, I got to get out now, the yield curve inverted, you have literally missed out on like a 30% return. It's unbelievable.
Yeah.
So what point am I trying to get across here is that you just have to stay in because you don't know what's going to happen. The smartest people in the world don't know what's going to happen. Let's go next. All right, Sheila and I use this in our seminar all the time. This is really cool because it shows you, if you go to the right, okay, can they see the years down here? Right? So these are the years, all the way to 24. It shows you the end of the year return. So check this out. The end of the year was 27%, but at some point in the year, you were -5. So what if you looked at your statement or your coworker said, oh, this is the big one,
Yeah.
because you're -5, but you actually ended up 27 for those who stayed in. Intra-year, mid-year lows, right? The mid-year low was -20. If you were brave enough to stay in, you still lost, but you ended up -6. Not bad, right? Intra-year low, -10, ended up +13. So Mr. and Mrs. Client, there's going to be times where you get your quarterly statement or you log in and you're going to see that you're down for the year, but what this shows us is that even when you're down for the year, you can actually still end up really positive. All of this is conditioning the client. Because I don't want that phone call. I don't want that anxiety. Can you bring up ICA?
Yes.
Okay, so let's go to the diversification page. So this is where I show them that we are not doing individual stock investing like what you just saw, where your money can go up 300% and then you can lose everything, or a company goes out of business. Another just like fun fact for you guys who are actually interested in investing. Investing in IPOs is the worst investment in the world. Don't do it. There's other charts I have that show you any company that goes IPO, when you invest on the day of the IPO, 5 years later, you're still down, okay? All the venture people, all the inside people, they already made all the money. Stock is very expensive. Rare occasions it can work out, but mostly not. So what I tell them is, I say, listen, we're not investing in individual stocks, we're investing in baskets of stocks. A mutual fund. It's mutually funded by all of us. It has hundreds of billions of dollars, and it has hundreds of stocks inside. Now, this guy didn't know anything about investments, but has he heard of Amazon? Has he heard of Meta, which is Facebook? Has he heard of Alphabet, which is Google, and Microsoft? Has he heard of Home Depot? Has he heard of Chase, right? Netflix? He's heard of all of them. So what are the chances that all of these companies can go under at the same time? It's impossible, right? And that's that diversification, it gives you protection. This is another visual that I drew for him. I said, a mutual fund is like this. Imagine a bunch of, these represent companies in your portfolio, and there's so many of them, the assumption is that a lot of them are gonna go up, some are gonna go down, but more go up than down. That's what creates a positive return for you. As you have to help them make sense of what they're seeing on their statements. Let's go down to time, where it shows the pie chart. Right there. Okay? So when you invest in a 1 year, any 1 year you choose in the history of our funds, any 1 year, if you just randomly blindfolded pick 1 year, you have a 67% chance of being positive. I don't think that that's good, which is why I don't take money for 1 year. If you invest for 3 years, you have an 87% chance of being positive. If you invest for 5 years, now we're talking 93. So my minimum investment is for 5 years. This is how I get away from people making early withdrawals. I do not want early withdrawals. I had a guy that, you know, he got a medical settlement, he invested all the money with me, I educated him, he promised me he wasn't gonna take the money out, he's withdrawn almost all the money, and then Primerica Home Office interviewed me yesterday for half an hour about why did this happen. This is serious shit, man. You can't just take people's money, put it in, they're paying fees, they're investing it, and then they're taking it out a year later. It happens even to me. But this is why I do all this stuff on the front end to avoid that happening. Now, I've covered my butt, right? So it's not like I'm getting in trouble, but they have to do it if the regulators ask. They have to have all the notes there. 10 years, 100% positive. So what that means is that we're not allowed to guarantee results, but we can tell you historically, if you kept your money in for 10 years or more, you virtually eliminated all the risk. We can't legally say that, but that is what has happened. 10 years or more, you are going to be fine. Go up to the chart, please, the mountain chart. So this is the mountain chart. It shows every return since 1934. Let's go to the later years. It shows the positive are blue boxes, the negative are red boxes. So -1, up 15. Let's look at the down years. -1, up 14. -6, up 24, right? -15, you're really, I always say this to the client, -15, you're really mad at me. Next year, plus 28. Right? I'm conditioning, right? I'm preparing for all this. You are mad at me. But look what happened, 28. Anytime we see a down, we see a big up. -34, up 27, up 10. Now, most of the people around you, Mrs. Client, when they see a -34, what do you think they're doing? They're selling, they're getting out. But guess what my clients are doing? They're putting more money in because they anticipate the biggest years. I teach them the biggest years comes after a downturn. All right, let's go back to the slideshow. All right. So, this does a lot of things. This is a hypothetical. You can create these in 30 seconds, but they have a huge impact. Someone investing $7,000 a year. What is significant in investing $7,000 a year, $583 a month? That is that's the amount that you can fully fund an IRA with, Roth IRA or regular IRA. It is showing that you are going to pay a fee up front. So Mr. and Mrs. Client, you're sending $583, $549 is what's going in. So when they see their statement and they say, hey, there's a sales charge here, they've already seen that. So these returns are reflecting maximum fees. I'm not showing you this amazing investment portfolio, but then it's really a lot less than that because of fees. This is net of fees, already taking into account. If someone did this starting in 1984, because we can't look forward, but we are allowed to look backwards, in 2004, 20 years later, they have $700,000 from putting in $7,000 a year. So they put in about 140, and they have, you can see, 700. Let's go next. After 30 years of investing, they have $1.5 million. Now they're no longer putting money in, they're retiring off their money. we're withdrawing 6% a year from the ending balance. You can see you have a 6-figure retirement. In 10 short years, you've already taken out 1.2 million, but today you have how much? 2.7 million with a 12% return. Right? So let me show you this. You put in 200 over time, you took out 1.2, and today you still have 2.7. Amazing. Okay? Now, it's not always up. Let's take a look at this. You remember what happened in 2008? Well, your money went from 1 down to 6. I know that's very scary. But that also happened to your home too, right? Didn't home prices crash? Did you say, man, I gotta sell my home now, it went down? That's the last thing you would think. What would you think? Well, let's just sit this out, it'll eventually come back up. It's the same thing with investments. People always say, they say, oh, I lost money in my 401k. You only lose when you sell. Right? So when your account just goes up, that's unrealized gains. When your account goes down, that's unrealized losses. If you sell, you actually realize it. You do not want to do that. So then the market goes up, 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 up. We remember what happened in, what was that, 22?
22.
And 22 went from 3 million down to 2 million. Tough, okay? Now we're pretty much back where we were. Did it really affect your income? No. The market's going to do what the market's going to do.
Right.
But again, it's addressing fees. I'm not just talking about ups, I'm showing downs. Okay, let's go next. Let's go through a couple points. Right? Let's go through a couple points. This is what I told him, the 26-year-old. I said, there's no, and I kind of dumbed this down a little bit, but I'm telling you guys, there's no informational advantage in the market anymore. There's no informational advantage. What that means is no one knows one thing that's a secret to someone else in terms of money management. We're all investing pretty much in the same things. So the only real advantage, or what we call arbitrage, that you have is time. So the sooner you get in, the more money you are going to make, bottom line. Everyone that's invested properly is going to get that 10 to 12%. The difference is Adric is starting at 20 and you decided to start at 45. And there's a humongous difference between that. So the only advantage today is how much time you have. So we got to start when? Early. If you look at the market, right? It's invest or die. And that's not a literal thing. It just means that it is impossible for you to become financially successful just off of a salary. You have to participate in the investable economy, the investing economy. That could be because you work with a company and they're giving you stock of the company, fine, you're involved. You should definitely be doing the 401k. You should be definitely doing IRAs and brokerage accounts or whatever, but you absolutely have to. That's why people are getting left behind. Look at the returns. That's why inflation won't go down. That's why everyone seems like they have so much money, right? Because if they're investing, they're capitalizing on all this stuff. It's amazing what kind of money people are making on their accounts. I mean, I was looking at it, the 15-year average is 15%. It's unprecedented, right? And some people say, oh, it has to revert back to the mean. We gotta have some down years to average it out. I don't know. There's new economies being built before our eyes, new industries. Space, we don't know what's gonna happen with space. Is that a new industry? Genomics, right? They're gonna tinker with our health with software. What's that gonna do? What if they can eradicate disease? What if, like Elon Musk says, there's more robots than humans? What if we have autonomous driving? What if we have things that are gonna help us live longer? All these different techs, how do you capitalize on all of this new innovation and technology? It's by investing in the market. There's so many more addressable markets that are being created. You don't know what kind of return so we have to get our clients to invest. Here's the thing. If you missed 5 of the best days in the last 5 years, it cost you 4% per year. 4% per year. So just those 5 days added 4% to the return in the last 5 years. Do you understand that? 4% in investing? It's unreal. Someone told me the other day, and I always log these things in my mind. They said, yeah, my friend just took their whole 401k and moved it in cash. And I was like, why the hell did they do that? Oh, well, you know, last week they missed that 1% down when the market went down. So I'm calculating in my head, ever since she told me that, I'm like, okay, now you've missed X percent since. Because always remember, when you take your money out, if anyone ever tells you, I'm taking my money out, you have a harder decision as when to get back in.
Right.
Right? So you have to make two choices, when to come out, but now when to get back in. And like we just told you, financial media is so biased towards the negative, you're always going to be scared to get back in. And now come to find out, you've been on the sidelines for 5 years.
Yeah.
Happens all the time. So we got to keep them in. If you have enough courage to invest when the market is down 20%, which is tough because everybody's scared. But if you can do it, on average, your go-forward return over the next 12 months is positive 18. So when the market is down 20, if you invest at that time, on average, you'll make 18% the next 12 months. Why is everyone so scared? It's because negative events happen quick. They're immediate. You remember the time, right? Progress is gradual. You get the 2%, and then another 2%, and then 3%, and then 5%. No one remembers it. It just kind of happens over time. Whereas the negativity is like, it's immediate. Here's a good one. Anything you do to reduce volatility in the short term is going to cost you return in the long term. Hey, can we put half of this in cash right now? You're trying to reduce your volatility in the short term. Well, it's going to cost you in the long term.
Can you repeat
Let's just get the money in.
Can you repeat that again?
Sure. Anything you do to reduce volatility in the short term will cost you in the long term. Next, this is good, especially for the young people and everyone. Singles and doubles have created many millionaires. Home runs lead to strikeouts. Okay? So if you have all your money in crypto, you're trying to hit a home run. I'm not saying don't have some money in crypto. Just like I'm not saying don't have some of your money in bonds if you want that. Or don't have some of your money in international. Right? It's just another asset class. But people who go all in, they're trying to hit home runs. And when you go for home runs, then you can strike out. I know people, they drove their account up with options to 8 million and it all the way down to 0. Like, I personally know people. Next. Here's another thing. Other advisors, they'll say, oh, Primerica, they're just taking you in funds and it's just going to sit there. It's a buy and hold strategy. They're not doing anything with your investments. Well, I just showed you 30 years in the same fund how well it performed. And what they're doing is they're trying to actively manage. But here's the thing. Buy and hold seems easy, but it's hard. It's hard to do nothing. People want to react. People want to tinker with their investments. People want to change. People want to feel like, you know, they can be preemptive in some way or you know, kind of see the future or prevent a downturn.
Right.
It's not as easy as it sounds, and that's why you need someone with you to just keep you in. That's it. Put more money. Only thing you can control is how much money you put in and not getting out. I won't get into this, but this is a good one. Stability creates instability. When the market is doing really well for a long time, that actually creates the instability. So the market, as a cycle, it has to fluctuate. It has to go down sometimes. But the good thing is that when it goes down, the people with the 7 trillion, it gives them a new entry point. They've been waiting for that, and then the market goes back up. It's really interesting when you learn about it. Investment performance doesn't determine real life returns. Investment behavior does. Our funds and our investments are going to produce the returns for you. The question is, are you going to allow it to, or are you going to constantly be going in and out? And lastly, in personal finance, we overvalue math and we undervalue psychology. It's all about psychology. So we're showing the numbers, we're showing the returns, we're showing the graphs. It's like, that's all math. But all the stuff that I went over today, that's investor psychology. Sometimes people, other financial people, they say, oh, but you're putting people in the annuities and they can't touch the money for 6 years. Now I have a good answer. I say, that's the behavioral component. It's good for the client. It's good because a lot of my clients who have messed with their investments or took out excess money or early withdrawals, the annuity, they always let it sit. It's the other funds that they did that with, but they knew with the annuity, higher penalties and issues in taking the money out. The fact that they can't touch it for 6 years is actually a very good thing for the client. Okay, guys. If you have any questions, you had one question.
Oh, I was just gonna ask, I think you pretty much answered it, but I was just gonna ask, was there ever a time that you invested in a stock and it decreased like significantly where you had to remove your money?
With Primerica investments or me personally?
Both.
Primerica investments, no. If something goes down, you have to wait till it comes back up. Have I lost money in stocks? Lots of money, lots of money. Okay. So, convention, set appointments. We're halfway at the month. Finish the month strong. Incentive, team on three. 1, 2, 3.